The S&P, and that little red arrow marks the end of the bull market and the beginning of the bear market. And a couple of bars later, a bar later, I think this next blue bar, that's where I was speaking at the conference, before the conference, I sent an article to the newspaper which organized the conference, and my headline was, be careful where you stand when the tree falls.
What you're going to be doing is step one, you're going to be drawing on your levels of support and resistance. Start with the monthly, get out to the weekly, down to the daily. All right, draw those levels of support and resistance. There'll be horizontal levels of support and resistance. There will be probably sometimes clear trend lines. Other times there might be big round numbers. Okay, big round numbers, psychological big round numbers that are important. Draw them in. Okay, build the picture.
So, just very quickly, the real body's relationship between the opening and closing. If it closes higher than the opening, it's an empty or green real body. The top of the upper line is the upper shadow, the high of the session, low of the session. The opposite with a red real body. I know I'm going through this very quickly. And so a doji is when the opening and closing are the same. And the reason the Japanese, they used to use bar charts for my research. I had about 14 books translated from Japanese to English. And they used to use bar charts up until about 1900 or 1910. And then they switched over to candlestick charts. And the reason for that is, although it's the same data as a bar chart, you get so much more visual information about who's winning the bull between the bulls and the bears. And that's why, I mean, if you think about it, if it wasn't for me, everybody in the Western America would still be using bar charts.
Heavily. I will not short heavily until I get a confirmation that this rally has failed. You don't need to catch the bottom. You don't need to catch the top. As a successful trader, you need to take a good chunk from the middle. So don't be a hero. Don't start shorting too early. That's what I have a few shorts. I don't have any long positions. And I'm a bear.
The bottom part is the business cycle. Can you see my cursor?
Yes.
Right. So the business cycle of Monday, then we proceed to the commitment of traders report. Then we go to sentiment and then seasonality. So that's my macro background. Again, each of these steps has to be rules based and with indicators, frameworks, checklists, and so on and so forth. Then I progress to the technicals, because once I've got the macro picture, then I have to go into the technicals. Now I've got the trend roadmap, basically seeing what the trend, market structure, pattern recognition, and so on and so forth. Basically the trend, if you wanna liken the like a car, if you wanna go, for example, moving from London to south, so from Southampton, you're going south. Obviously, if you're going to Manchester, you're going north. So the direction where the car is going is basically your trend, bullish or bearish. Then I go into momentum. Momentum basically is the speed that the car is using, because the car may be moving at this direction, but you're going 70 miles or we're going 50 miles. Yeah. Then I see volatility, which is a big part, because volatility, as my friend John Bollinger once said, low volatility is where trends are born, and high volatility is where they go to die. So it is a very good technical setup. And also you can also use it for risk management. And the fourth is what I call the relative ranker. Basically, so if you've got two cars headed in the right direction, in one direction, for example, going from London to Manchester, they're going north. You may see their speed, but that's the momentum is the speedometer. The odometer is relative strength. So one may be halfway the distance, one may already have reached Manchester. So it's always good to see which market has traveled the furthest. And the last part is basically taking all this information and taking it into a trading setup, which is basically a trading plan, which is basically what I call the 4S framework: setup, signal, size, and stops. Because each trade is comprised of these four parts. No matter how you trade, is the setup, basically why you want to be going into this direction, bullish or bearish. the signal where you actually, physically get in, the size, and the stop. So that's my general framework.
The high established in February at approximately 4,200 level of the S&P. After that, we had a higher low, and I've said repeatedly, if the market decisively breaks above that line, not just for 2-3 days and then go back, but decisively breaks above that line, I will have to recognize a bull market. And of course, that happened just about a month ago. This is certainly a very decisive breakout here. Right now, the market is, the S&P is overbought. You can see how on the weekly chart, it's hitting its upper channel line. And that's really the sign that the market is getting a little bubbly, a little hyperactive. If we go to the right side of the screen, to the daily chart, we can see that the S&P went outside of its channel last week. It's now pulling back a little bit this week. At the same time, if we look at the bottom, very bottom pane on the right, the force index, and you can see how the force index is getting weaker and weaker. So the market is entering a correction, but it's most certainly, it's a correction within a bull market.
Probably started when I was a kid. My grandfather gave me some shares of a stock it was the stock was the Frughoff Corporation, no longer with us. But it was sort of the tech stock of the day. It was the beginning of containerization, and they were a company that manufactured containers. It was just, we were getting the first ships that used containers and trucks and stuff like that. So what it was the a tech stock of the day, and of course, when my grandfather gave it to me, it was a bubble stock. So from the time he gave it to me, it did nothing but go down. Okay. And so that was a really good lesson, and then from there, when I was going to school, I had a job, and one of my bosses was really into the market. His father was actually a very famous over-the-counter market maker, and that kind of rekindled my interest. And then the final piece was really interesting. My mother owned a small advertising agency, and she was preparing to retire, and she was getting really terrible financial advice. And the interesting thing is that she recognized that and wanted to make a change. And she called me up and said she knew I was interested in stocks in the stock market and such like that. And she asked me if I would manage her retirement. And that was the beginning of my transition into the markets full time.
So this could well become a false downside breakout, which is a very bullish pattern. But at this point, so be on alert to buy Singapore, but not allowed to buy it today. It's still red. Taiwan, red, well above 2023 lows. UK, red, well above 23 lows. Mexico, it's actually green. Mexico has turned up this week. It took out previous week's high, and it's quite strong. Our southern neighbor. Canada is weak, Mexico is strong. The first non-red market. South Korea, red. Brazil, another rallying market. It turned blue, neutral. India, also neutral, blue. And China, red. So out of 14 markets, we have 11 red ones, 2 blues, and 1 green. Certainly, it's a very bearish situation, although some of those red markets appear to be potentially drawing false downside breakouts, which is a very bullish pattern. But I find that the impulse system keeps me out of a lot of trouble. It forces me to sit on my hands and not act, while not to guess, not to jump in too early. So the impulse system on the weekly charts of 14 world's key markets are almost all red, with just two blues, as I said, and one green.
Side. So Theo made a little bit of a comment about earlier, but when I look back on this year, okay, in 2023, the kind of themes that I have been seeing and the themes that I've been working with have been one, that we have seen rises in global interest rates, okay, across all of those major economies that we would probably look to be actively trading in. But now we're starting to see a pause in that, okay? Certainly over the last week, we have seen a shift, okay, from those rate hikes to pauses. And I suppose one of the questions which might come out in our conversation is, is that really a pause? Or are we done, okay, in terms of rate hikes? And could it possibly be that actually the next move is down rather than up?
The thing here is that right now for December, which is very interesting, we're currently seeing that the market is now expecting the Fed to keep rates at the current level and not hiking it as the dot plot suggested, which is very interesting because you might say, hey, if the Fed already told us around 2 weeks ago, 2.5 weeks ago, that there will be another rate hike. This is what the Fed dot plot suggested. So probably recall or review the recording which we uploaded on the YouTube channel from Admirals here. So, well, why is the market then not expecting that the Fed is following through? Well, because if you follow through as the Fed, well, then you're heading into potential trouble. We've already witnessed it in March this year in the banking sector with Signature Bank, with Silicon Valley Bank, with First Republic, all failing due to their involvement in the bond market and betting on the Fed to continue to keep rates at zero, which the Fed obviously didn't. Not sure what the managers were thinking about this, but this is another topic. And now what you see is the longer the Fed keeps rates elevated and potentially increases them even further, even though inflation is already trading way below the current target rate. So inflation numbers which came in, which will be released, by the way, next week again. Is it next week? I'm not sure. Or the week after, I'm not sure. But however, we're way below the target rate, which means if we continue to hold level rates here, even cutting them slightly, you will likely over time bring inflation back to the target rate around 2%.
I have a couple of really smart people there who occasionally publish there. And one of those people is this guy, Mark Halbert. You can see his name here. He is an interesting guy. He is quite old. He is a member of, he's a Quaker, which is a very interesting religious, Christian religious sect. He doesn't trade, but he is one of the best statisticians there is. And what he wrote after this great rally exploded last week, here is the headline: Bear markets love explosive rallies. He calculated 25 strongest rally days in any index, in the Nasdaq, in the S&P, in the Dow, and the strong 80% of the strongest rallies occurred during bear markets. That's it now. I looked earlier this morning. There's a very smart guy in Minnesota who, by the way, there is. I don't know if he will agree to an interview, but if you decide to approach him, I'll be happy to introduce him. This guy, Jason Gopford. He has a tool. He measures the bullishness among dumb money and bullishness among smart money. As of yesterday, the bullishness among dumb money was 96%. 96%. The bullishness among smart money was 39%. And you can see using my tools, these extremes of force index, you can see that at the right edge, there is a buying panic. What's going on in the markets is buying panic. And people are just afraid to miss this wonderful train that's going away from them. Except the train always pulls back and makes a stop, returns to the station. So my view of this chart, looking back and looking forward, it's bullish, but it's due for a pullback.